Hello, good evening, greetings to all my dear friends. I hope you all are excelling in every possible domain of your lives. Dear friends, today we are going to have a very in-depth discussion on the overall growth prospects and the potential of the Indian economy as S&P Global's Mr. Louis Kuij is quite optimistic about the same. The Indian government needs to present a convincing argument to the global firms that it is economically stable and predictable in terms of the policy measures to pull the national corporations and the multinational corporations which are looking for an alternative to China, said S&P Global Ratings chief economist for Asia Pacific Louis Kuij in an interview with ET's Atmadeep Roy. Exuding optimism about India, he said that apart from carrying out the institutional reforms, the domestic demand would help the economy to continue to grow at a high single digit. Now here is the question answer round with this great pioneer. First question put to him is, while several Western markets are facing recession, will the Asian economies stand out? And where does India stand? To which he answers, the lack of growth in the West is a headwind by itself for the Asia Pacific region. If you want to look at it from a relative point of view, we are going to have significantly better growth here in Asia. What's happening in West is actually negative, but in Asia, we are looking at growth that is coming down, but not completely going away. If you look at the economies that are best placed for growth in an otherwise difficult time, it is the economies where the domestic market is robust and monetary tightening did not have that much of an impact. In that perspective, India does come out as an economy where there is the domestic demand strength, while the monetary policy impact is not as big as seen in the markets like Australia or South Korea. Second question put to him is, even though India logs growth despite the tightening, fresh investment is not taking place yet. What is your reading on this? He answers, the corporate capex, that is the capacity expansion, seems to be the negative in the investment story. It is not a great time for the capex. Like in China, where corporate capex is weakening because of the slowdown in the global economy, India faces a somewhat similar story. Can the domestic demand offset that? I'm not sure. Maybe you have to be the little bit more patient in terms of the private sector capex story. This is also not a great time to rely on public sector investment. The government needs to watch out a little bit in terms of its fiscal management. This is not a time for expansionary fiscal policy. I'm not saying there is no room for infrastructure investment, but the government cannot go out of its way for large expansionary spending. Third question asked to him is, does the fall in China's manufacturing output for 2 consecutive months give India a chance to raise share in the global manufacturing market? Or is it just a temporary phenomenon in China as the COVID restrictions have already been eased? To which he says, I think there is a chance for India to increase its share in the global manufacturing pie. But I would look at a little bit longer perspective because, as you said, the restrictions have been lifted as we speak. Cyclically speaking, we expect the Chinese economy to improve in the year 2023 compared to the very weak performance this year. The bigger question is if there is room for the Asian economies to pick up and absorb some of the manufacturing capacities that firms would be keen to relocate out of China. I think there is a major opportunity here for the economies that can present a convincing picture to the international investor community in terms of the economic stability, predictability, in terms of the business climate. And if they can show that some of those traditional constraints that hampered FDI in the past are now less binding. If the Indian government can present a picture like this, I do think that there will be interest, as we have already been seeing among the Taiwanese investors, US investors, Korean investors, and probably among the Chinese investors. Next question asked us, is Taiwan or South Korea somewhat better placed as compared to India in attracting the manufacturing capacities which may shift out of China? You know, Taiwan is a relatively small economy with fairly sophisticated manufacturing ability. I see Taiwan as complementary to the Indian economy. India can try to convince some of the Taiwanese companies that are looking to relocate their investments out of China. However, the Taiwanese would not look to relocate their sophisticated semiconductor units, but the other elements of the supply chain. These would be complementary to the Indian manufacturing units. For India, the competition would be more with Vietnam, as we have been seeing in our preceding sessions as well. Another issue one needs to keep in mind that is when the COVID-19 broke, everybody was expecting large-scale relocation out of China, but it was rather slow. Fifth question asked to him is, in the overall analysis, are you positive or neutral on the Indian economy? Actually, India for a long time has been a country with potential, with great potential. In the past, India cannot live up to its potential because of the bottlenecks in the infrastructure side, land acquisition, and also in terms of the legal aspects. I do think the situation has improved. For investors, I think the picture is more convincing now that what it was 8 or 10 years ago, in addition to this potential, there is now the domestic momentum and energy. So there is no reason why India cannot continue to grow exponentially and at a very solid single digit. In that sense, I am positive about India. What a great news. Really fantastic. Next question put to him is, what is the most striking change you noticed in India? He answers, I'm not an expert on India, but one thing is quite noticeable. 10 years ago, when investors were complaining about the rising wage costs in China, and when they were looking to explore their other geographies, they went to Vietnam, they went to India, but often they came back very, very disappointed. They were a bit overwhelmed by the challenges in India. Now, we can see the actual commitments by some of the Taiwanese suppliers and by other US manufacturers. If I ask myself why that is, the answer is India's infrastructural improvement. The GST reform with tax system being less distorted and some of the institutional reforms like implementation of the bankruptcy code. Now, coming back to the world economic trend, there are signs of inflationary pressure coming down. In India, the consumer price index for November was at 5.88%, below the Reserve Bank of India's upper tolerance level of 6% for the first time since April. What a lovely news. But are we actually celebrating too early? To which he says, Nobody doubts that inflation will come down. The big question is, how quickly will it come down? The market has gone a bit ahead of itself in expecting quite a rapid drop in inflation. But if you think of what is driving inflation at this point, it is not the oil prices anymore. It is domestically generated inflation by the firms passing on the cost increases and workers' demand for high compensation. I think the market is a bit too optimistic about how quickly inflation will come down. As a result of that, they are too optimistic about how quickly the US interest rate has come down and will come down. In India, the good part is that headline inflation has come down. The less good part is that core inflation is actually higher than the headline inflation. Like in the United States, India too has quite a stubborn core inflation. It is not actually easy to bring down the core inflation that can inflict some pain on the economy. The only way to reduce the wage inflation is to moderate the inflation expectations. So that was the question answer round with this great pioneer leader from S&P Global, Mr. Louis Kuij. So this basically reveals his broad insights about the global economy, the current scenario, and for the coming times, what does he expect? What are the challenges and what are the opportunities? And what does he expect from the Asia Pacific region, especially from the Indian economy? What all expectations does he have? So overall, he is quite optimistic about India's prospects. So dear guys, it's such a lovely news to read. Now, my dear friends, going forward, we are basically going to discuss how the Indian households predict about the double savings in the next 5 years as per CRISIL. The Indians' savings is basically turning into stocks and bonds from the conventional real estate and gold at an accelerated pace that has the potential to change the capital dynamics. Rating agency CRISIL forecasts the financial savings to rise to 315 lakh crore rupees or 74% of the GDP by 2027 from 135 lakh crore rupees or 57% last fiscal. As of the last fiscal, AUM of the managed funds industry amounted to 57% of India's gross domestic product, said Mr. Ashish Vora, President and Head, CRISIL Market Intelligence and Analytics. So in the next 5 years, we see this proportion rising to 74% as the overall financialization increases. Much has happened in the investment landscape over the past 5 fiscals, yet the industry has barely scratched the surface given the potential in different categories and compared with how such assets have grown in the developed countries. Household savings comprised over 2/3 of India's gross savings except for the pandemic period when it shot up to 78%, touching 43.9 lakh crore rupees. So the directed efforts at financial inclusion, digitization, a longer-term trend of rising middle-class disposable incomes and government incentives on these instruments have better channeled these savings on the industry. So with rising inflation, households too are seeking higher returns than the fixed deposits can offer. Life insurance companies comprised the biggest chunk of the managed investments with a 39% share at 52 lakh crore rupees. The mutual funds with assets under the management of 28 lakh crore rupees and a market share of over 28% came next, the CRISIL study showed. Investments in the Provident Fund to be increased to 25 lakh crore rupees at the end of March 2022, while the corpus in the National Pension Scheme increased to 7.36 lakh crore rupees. Though these represent only 10% of the household savings, but they have gained significant market from bank deposits. The pace of technology and intermediation remains crucial in driving the product penetration, said Mr. Jiju Vidyadharan, Senior Director, CRISIL Market Intelligence and Analytics. Development of a distributor segment through sufficient incentives to expand their network will be the key to increasing both penetration and financial awareness in the hinterland. Mr. Vidyadharan added that similar taxation and regulation would send out a more coherent message, helping the investors take better informed decisions based on their risk-return profiles rather than spend time grappling with various complexities. So, here we have got broad insights about how the Indian households need to double the savings in next 5 years as per the CRISIL, wherein we have studied that directed efforts at financial inclusion, digitization, a longer-term trend of rising middle-class disposable incomes, and government incentives on these instruments have better channeled these savings to the industry. So with rising inflation, households too are seeking higher returns than the fixed deposits can offer. So these valuable insights, I really believe, will help to enhance the overall skill base and the overall knowledge you possess about the Indian economy, its overall fiscal and monetary aspects. So dear guys, that's all for today, and I really hope you take good care of yourselves until we meet next. Thank you so much. Namaskar. Jai Hind.